Here's something that shouldn't make sense. The United States government is over $36 trillion in debt, yet it keeps spending money it doesn't have, and somehow, the entire system hasn't collapsed. In fact, it's been working this way for decades. But here's the part that really bends your mind. A significant portion of that debt? The U.S. government owes it to itself. That's right. The Treasury borrows money by issuing bonds, and then another part of the government, the Federal Reserve, buys those same bonds, essentially creating money out of thin air to purchase the government's own IOUs. It sounds like a magic trick, or maybe a Ponzi scheme, but it's neither. It's called monetizing the debt, and it's one of the most powerful and dangerous financial mechanisms in the modern world. So how does the U.S. government buy its own debt? Why does it work? And more importantly, what happens when it stops working? To understand this trick, you need to know the players. First, there's the U.S. Treasury, which is essentially the government's bank account. When Congress approves spending that exceeds tax revenue, the Treasury needs to borrow money. It does this by issuing bonds, promises to pay back the money with interest at a future date. These bonds are sold at auctions to anyone willing to buy them: foreign governments, pension funds, banks, and everyday investors. But here's where it gets interesting. There's another player in this game: the Federal Reserve, America's central bank. The Fed isn't technically part of the government. It's an independent entity, but it has an extraordinary power that no other institution possesses. It can create money digitally with the stroke of a keyboard. And since 1913, when the Federal Reserve was established, it has been quietly, and sometimes not so quietly, buying government bonds. Now, you might be wondering, if the Fed can just create money to buy government debt, why does the government bother collecting taxes at all? Why not just print unlimited money and fund everything? The answer to that question reveals why this trick works in the first place, and why it's so dangerous. But before we get there, we need to go back to where this all began. The Federal Reserve was created in 1913 after a series of financial panics convinced Congress that America needed a central bank to stabilize the economy. But the founders of the Fed never imagined it would become a direct financier of government debt. In fact, for decades, the Fed operated with strict limitations. It could influence the money supply and set interest rates, but directly buying government bonds in large quantities? That was taboo. The memory of hyperinflation in places like Weimar Germany, where the government printed money to pay its debts and destroyed the currency, haunted policymakers. Everyone understood that when a government starts financing itself by printing money, it's a slow march toward economic catastrophe. But then came World War II. The war required unprecedented government spending, and the Treasury needed to borrow massive amounts of money. The Fed agreed to help by buying government bonds to keep interest rates low, making it cheaper for the government to borrow. This was seen as a temporary emergency measure. After the war ended, the Fed tried to regain its independence, but the precedent had been set. The government now knew that in times of crisis, the Fed could be a lender of last resort, not just for banks, but for the government itself. For decades after World War II, this arrangement stayed relatively quiet. The Fed would occasionally buy or sell government bonds to manage the money supply, a process known as open market operations. It was technical, boring, and most people didn't pay attention. But the purchases were small and strategic. The Fed wasn't financing the government's budget. It was managing economic conditions. Then came 2008, and everything changed. The financial crisis nearly collapsed the global economy. Banks were failing, credit markets froze, and the government needed to spend trillions to prevent a complete meltdown. The Fed slashed interest rates to zero, but it wasn't enough. So the Fed did something radical. It launched quantitative easing, or QE. This was a fancy term for something very simple. The Fed would create money and use it to buy massive amounts of government bonds and mortgage-backed securities. Between 2008 and 2014, the Fed's balance sheet exploded from less than $900 billion to over $4.5 trillion. The Fed had become the single largest holder of U.S. government debt. At the time, economists debated whether this was genius or madness. Supporters argued that QE prevented deflation, stabilized markets, and gave the economy time to recover. Critics warned that the Fed was setting a dangerous precedent, that printing money to finance government spending would eventually lead to runaway inflation and currency collapse. But for years, the critics seemed wrong. Inflation stayed low. The economy recovered. The trick appeared to be working. But then came 2020, and the Fed did it again, only bigger. When the pandemic shut down the global economy, the government passed trillions in stimulus spending, and the Fed pumped trillions more into the financial system. The Fed's balance sheet ballooned to nearly $9 trillion. Money was being created at a pace never seen before in peacetime. And this time, something different happened. By 2021, inflation began to rise. At first, officials called it transitory, a temporary side effect of supply chain disruptions. But the inflation kept climbing, 3%, then 5%, then 7%, eventually peaking above 9% in 2022, the highest rate in 40 years. Suddenly, the trick didn't look so magical anymore. People could feel it in their grocery bills, their rent, their gas prices. The Fed had created too much money, and now that money was chasing too few goods, driving up prices across the economy. The Fed was forced to reverse course, hiking interest rates aggressively to fight the inflation it had helped create. But here's the painful irony. As interest rates rose, the cost of servicing the national debt skyrocketed. The government now spends over $1 trillion per year just on interest payments, more than it spends on defense. The trick that was supposed to make borrowing easy had become a trap. So where does that leave us? The U.S. government is addicted to debt, and the Fed is stuck between two terrible choices. If it keeps creating money to buy government bonds, it risks reigniting inflation and destroying the dollar's purchasing power. But if it stops, interest rates will rise even higher, making the debt even more expensive and potentially triggering a financial crisis as the government struggles to refinance trillions in maturing bonds. Other countries are watching closely. China and Japan, once the largest foreign holders of U.S. debt, have been selling off their Treasury holdings. The global trust in U.S. bonds, the foundation of the entire international financial system, is quietly eroding. And here's the scariest part. The same trick is being used by governments around the world. The European Central Bank, the Bank of Japan, the Bank of England, they've all followed the Fed's playbook, buying up their own government's debt to keep the system afloat. Japan's debt-to-GDP ratio is now over 260%, the highest in the developed world, and the Bank of Japan owns nearly half of all Japanese government bonds. It's a global experiment in monetary policy that has never been tried at this scale, and no one knows how it ends. If this all sounds familiar, it should. Throughout history, governments that finance themselves by printing money have faced the same fate. The Roman Empire debased its currency to pay its armies, leading to hyperinflation and collapse. Revolutionary France printed assignats backed by confiscated land, which became worthless within a few years. Weimar Germany printed marks to pay war reparations, leading to hyperinflation so severe that people used wheelbarrows full of cash to buy bread. Zimbabwe, Venezuela, Argentina. The list goes on. The pattern is always the same. A government spends more than it collects, borrows to cover the gap, and when borrowing isn't enough, it prints money. For a while, it seems to work. But eventually, confidence collapses, inflation spirals, and the currency becomes worthless. The question isn't whether this pattern exists. It's whether the United States is different. Believers in American exceptionalism argue that because the dollar is the world's reserve currency, the U.S. has special privileges. Foreign governments and institutions need dollars for international trade, which creates permanent demand for U.S. bonds. As long as that demand exists, the trick can continue indefinitely. But the skeptics point out that every empire in history thought it was different, right up until it wasn't. Reserve currency status isn't permanent. It's earned through fiscal discipline and economic strength. And right now, the U.S. is testing the limits of the world's patience. So what should you take away from all this? First, the bond trick isn't magic. It's a strategy with consequences. When the Federal Reserve buys government debt with newly created money, it's not free. That money enters the economy, and if there's too much of it relative to the goods and services available, prices rise. Inflation is the hidden tax that everyone pays. Second, we're living through a massive monetary experiment with no clear exit strategy. The Fed has grown its balance sheet to unprecedented levels, and unwinding it without causing a financial crisis is extraordinarily difficult. Every option on the table, keeping rates high, cutting rates, buying more bonds, selling bonds, has serious trade-offs and risks. Third, the system works until it doesn't. For now, the world still trusts U.S. bonds as the safest investment on the planet. But trust is fragile, and it's built over decades but can be lost in months. If foreign investors lose confidence in America's ability to manage its debt, the consequences would be catastrophic. Not just for the US, but for the entire global economy. Here's the uncomfortable truth that no one in power wants to talk about. We don't know where the breaking point is. We don't know how much debt is too much, how much money printing is too much, how long the world will accept dollars in exchange for real goods. We're in uncharted territory, navigating by instruments that were calibrated for a different era. The bond trick has worked for decades, but every day it continues is another day closer to the moment when the trick is revealed to be just that, a trick. And when that moment comes, when the world collectively realizes that the emperor has no clothes and the bonds are backed by nothing but printed money and promises, what happens then? Maybe the system adapts. Maybe new rules emerge. Or maybe we learn the same lesson that every civilization before us has learned. You cannot borrow your way to prosperity, and you cannot print your way out of debt. If this story opened your eyes to how the financial system really works, hit that like button and subscribe for more deep dives into the economic forces shaping our world. Drop a comment below. Do you think the US can keep running this trick indefinitely, or are we headed for a reckoning? And if you want to understand money and markets on a deeper level, check out the next video where we break down exactly what happens when a currency collapses and what you can do to protect yourself. Thanks for watching, and I'll see you in the next one.